If you don't understand liquidity, the market will always take your stop loss before moving in your direction. Hello traders, hope you are doing well. Welcome to this new episode. In this new episode, you are going to learn liquidity. What is liquidity? Liquidity is the area on the chart where a lot of orders are waiting, usually above highs and below lows. The market moves to this level to collect orders, trigger stop losses, and fill big positions before choosing a direction. In simple terms, liquidity is money in the market and price is always attracted to it. Here are different types of liquidity. First one, we have buy side liquidity, BSL, and sell side liquidity, SSL, equal highs liquidity, equal lows liquidity, trend line liquidity. Hope it makes sense. So let's move directly to trading view. So here we are. First of all, let's identify our trend. What did I see here? A higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So we all know that we are bullish right now. The market is making higher highs and higher lows. Where is our sell side liquidity? Our sell side liquidity is here. I mark it with the red line here. Okay, traders place stop losses in the same areas. Most buyers, long traders, protect their trades by placing stop losses below recent lows. Okay, when many traders do the same thing, a pool of sell orders is created. This pool is sell side liquidity, as you can see here. So what do you see here? Here we have a lot of stop losses resting below this low here. Why? Because there is a lot of traders who are going to take a buy position from this demand zone, and their entry will be here, and they will put their stop loss below this recent low or this low here, like this, and their take profit will be at the higher high. After sweeping the stop losses resting below this sell side liquidity low, what did you see? The market reject and push to the upside with a lot of volume. Okay, hope it makes sense. Buy side liquidity, what did we see here? We have a higher high here. Traders place stop losses above highs too. Most sellers protect their trades by placing stop losses above recent highs. When many traders do this, a large cluster of buy orders is created. This cluster is called buy side liquidity. Okay, so the same thing I show you in the sell side liquidity example. What did you see here? The market start ranging a little bit here and took out all of the stop losses that are resting above this high. After taking out these stop losses resting here, what did we see? The market reject and push to the downside with a lot of volume. That's how we identify buy side liquidity, and that's how we mark them. Okay, let me show you a little more example. We mark our sell side liquidity here. What the market do? Reverse, sweep the sell side liquidity, and then push to the upside. Same thing here. We have a higher high. We mark buy side liquidity. The market reverse and sweep the resting stop losses that are here and reverse again to the downside with a lot of volume. So let's move to equal highs and equal lows. We have equal lows. Okay, traders use the same logic. When price forms two or more equal lows, most traders see it as support level, a safe place to buy, a logical place to put a stop loss just below. This creates a large cluster of stop loss orders under the equal lows. That cluster is sell side liquidity. Okay, the market simply move and sweep out all of stop losses resting here and push to the upside with a lot of volume. It sweeps equal lows and then target the buy side liquidity. After taking out this buy side liquidity, what did we see? A large volume downside candle here. Okay, so that's how liquidity is working. Like, the market always move from liquidity to liquidity. If you don't understand liquidity, like 70% of the time you're going to take a lot of losses. Okay, we have a new equal lows here again. What did we see? The market sweep out the equal lows and reverse a little bit again. Let's move to the last example. Trend lines are a must-have concept. Retail traders are tough. Buy at an uptrend trend line. Sell at a downtrend trend line. Place a stop losses just beyond the line. When thousands of traders do this, others pile up around the trend line. Okay, that concentration of orders equals to liquidity. We have 1 2 3 4 touches, so we have a trend line. We will be buy here and our stop loss will be here. We will be targeting this high. The market simply moves a little bit and reverse back to sweep our liquidity. After sweeping that liquidity, the price directly reacts from this demand zone here. Okay, so you see how liquidity is very important in our trading. So hope it makes sense, and I hope you enjoyed this video. Thank you for watching this video. Don't forget to subscribe and like and leave a comment. See you in the next episode. Happy trading.